Thursday to you. Welcome back to the live room. An allergy-filled week. Uh-oh. I think I messed something up on the live stream. Oh no, hold on. Oh, I think we're working now. This thing's been acting up all morning. Hopefully it is on, but welcome. Or she said she can hear me. Great. Yeah, live stream's giving bugs this morning, it looks like. So that may be a problem for them, not us, but hopefully it gets worked out. I just was a little late today because I was answering a question from a trader I got on Facebook. I shared a quote today. And the quote said, "It is a trader's job is to manage risk, but sometimes a trader's emotions and ego are the risk." And I said, "Accepting blame is difficult. Trust me, I've made every excuse in the world and didn't fully accept fault until I literally ran out of people and places to blame. The biggest risk that you'll face in your trading career can be found right in the mirror. And the sooner you start to work on that, the sooner your trading will start to improve." And I got the question underneath from Joshua said, "What should be the therapy when a trader's ego and emotion become the risk?" And I'd love to hear what you guys have to say. I'm going to try to get the live stream working. Again, it's not connecting to my actual screen, which is an issue. But hopefully this will buy us some time. It clicks on and then it clicks off. Let's see if it works this time. Yeah, we're trying. It's not it's clicking on and off. So it's on again right now. So you guys on YouTube should get it in a couple seconds, hopefully with the delay. But it's been buggy, which is unfortunate. But we'll see if it comes on. It's working right now on TradingView, which is who then streams it to YouTube. Looks like it may be getting on soon. The question was, what should the therapy be when a trader's ego and emotion become the risk? So basically, when you find yourself, what can you do when you find yourself out of your trading, your proper trading mind state? What can you do? And by the way, if you guys watching on YouTube, we're going to do another viewer's choice today. I do have something I want to look at, but there's not a whole lot on the radar, so I'm in no rush since we have a few hours here on the regular live room. But if there is something that you guys want to look at, just like yesterday, shoot it in, and we'll break it down for the trade of the day session. But what I said was, I said get away from the chart. Time away from the chart. If you ever find yourself in the wrong trading mind state where you feel like you're highly emotional, whether it be too excited, whether it be too scared, whether it be you're in revenge mode, get away from the chart. Take a step away. Do something else, right? Go on a run, go on a bike ride, watch a YouTube clip of I don't know, cat people or cats, or I don't know, something to get your mind off of the chart, right? What you essentially need is a reset. It's no different than, when your computer is running slow or when the monitors starts glitching and you just, you close everything down, you restart it and it's up and running again fresh. Trading is the same way, right? You need to reset. You need to do some type of pattern interrupt to get you out of that highly emotional state before you get back in the market. Because when you're in that highly emotional state, your judgment is going to be cloudy. You're not going to be seeing things the same way. And that's going to cause you to make mistakes. And mistakes are going to make your situation even worse. So that's what I had to type it in. I had like 10 seconds left on the counter and I had to type it in. All right. So we're in here. Again, YouTube, I'm going to give you a chance real quick if you want to type in anything you want to take a look at for the trade of the day. If not, we're probably going to head over to the Aussie S&P. There's not a great amount in the markets yesterday, but this is interesting. I was thinking about you, Evans, and your questions yesterday about, trading and how much is on the radar. And we talked about the markets, especially in the summer, how they tend to get a little bit slower, but that doesn't mean that trading opportunities still exist. I've had 3 new ones this week already, right? 2 last night or yesterday last night. And it's interesting because the market seems like it's doing absolutely nothing, but Aussie, Canada, we had Aussie dollar on the radar. That never ended up working out. But Aussie, Canada, which had a negative result. We had pound dollar. We had, what was the other one? Euro yen cipher. I believe it was euro yen. Euro yen or pound yen. I believe it was euro yen cipher. So even though the market seems slow, yeah, there's a pound. Yeah, okay. So it must have been euro yen because pound yen's on the radar for today. Even though the market seems slow, there are hidden opportunities, depending on how you trade, obviously. And these hidden opportunities sometimes come in bunches. So, and what I've noticed in really trading in general, but you get it more in the summer because the summer is even more slower, is the markets lull you to sleep. They seem like they're doing nothing, nothing, nothing. And then boom, you get 4 setups in a row. And they happen quick. And the whole deal from the market is to bore you, to get you out of your routine, to have you wake up a little bit later, to have you skip analysis at night, and then you miss the opportunities that you're supposed to have. So this is why it's critically important that we stick to our routine, that we stick to our process, that we come in and we do what we're supposed to do each and every day so we don't miss these opportunities, because we can't afford to miss these opportunities. Literally, that's what brings us income in trading. So I was thinking about that last night when I was like, yeah, we were talking about how slow and nasty the markets are, and then boom, 2 new setups. 2 winners, by the way. Now Aussie Canada doesn't feel that bad. All right, so no requests came in, so let's go to Bobby mentioned the pound yen. That wasn't the list. You guys want to do the Aussie, Australian S&P or the pound yen? Australian S&P's got a potential pattern, but also potential breakout. Pound yen's got a wedge and a bunch of patterns. Let me know. What? Hey, Akil, I'd like your thoughts on... pound Aussie. We did get a request. All right, we'll head over to pound Aussie. I see a double bottom on the daily. Perfect timing. All right, let's go to pound Aussie. Let me get my notes situated. And we will start on pound Aussie. Where you at? There you go. And we're going to start on the daily. So, pound Aussie on the daily. Now, the first thing that we have to do, and Orsi already says, I don't see a double bottom on the daily. And this is going to go back to something that we talked about a lot, which is one of the hardest things for newer traders in the market is that there aren't many common definitions, right? We have common terms. We have you've all heard of double tops. You've all heard of triangle patterns. You've all heard of head and shoulders. You've all heard of wedge patterns. Would I be correct in saying that? All of those terms sound familiar, right? All of the terms are familiar. However, if you look to define each of them, are you going to get one common definition for all of them? Is a double bottom going to be exactly the same across the board, every single book, video, educator? No. It's going to be different. And it makes it difficult for newer traders because typically newer traders aren't locked in on a single coach or a single mentor. They're kind of bouncing all around the place. And as they should at first, but until they find kind of, who the fit is for them. But imagine them bouncing around off of, 3 different YouTube channels and reading 3 different books on technical analysis. And now they've got 5 different definitions for what a double bottom or double top is. How hard is that? It's hard enough with one definition, right? It's hard enough having one definition and be like, oh, now I got to find this thing. Sheesh. Having 5, and Evan says that was me at the beginning, it's really hard because even if you find what to look for and then you try to confirm it and you ask someone, hey, I got a double top here, and like, no, that's not one. You're like, no, wait a minute. I just put in all this work to identify it. So it's very difficult, very difficult. So that's why I don't really like telling people they're right or wrong unless they're blatantly right or wrong. I just say it's not one for me. So when I think it was Ingrid says double bottom on pound Aussie, I can see exactly the double bottom that they're talking about. Now, is it a double bottom for me? No. But this is exactly what they're talking about right here. Now, and you guys notice because you've been with me for, well, every day here in the live room where I explain this, but why would this not be a double bottom for me? And again, when I say double bottom for me, it's a double bottom for me per how I look for it, per my rules, all that fun stuff. Yep, because of the depth of the retest, right? So the retest, here's our double bottom. And again, this doesn't have to be a definition that you use. But here's our double bottom right here. Our initial test, our retracement off of it, and then our retest right here. The fact that this retest came back to our previous new structure low, our previous level of structure, that's what causes it not to be a double bottom for me. At least a double bottom I'd be interested in trading. But it's still so I just call these retest of structure, which again, doesn't really matter what you call it, no, as long as you know how you want to use it. But the difference that this makes is that so what I would expect off of a rejection of this move would be a return to this level. This is the most recent level of structure. This is where I would expect price to return to. I don't know if we have previous structure looking left. Not too familiar. Yeah, we do. Let's see real quick. Yeah, we didn't violate structure. So we still are at a structure level looking left, right? So I would expect a move back to here. So we've already done this move, right? So right now, my expectations in the market have been fulfilled. They've been achieved. I don't really have too much else that I would expect. I don't have a reason to expect that price is likely to go higher. I don't have a reason to expect that price is likely to go lower. So in these situations, I'm in a kind of finger off the trigger mode. I need to wait until the next signal. Right now, obviously, you go lower time frames. There are all types of micro moves that can be inside of here that we can look at. But focusing on the daily chart here, I need to wait for the next signal in order to kind of have an idea of how I would want to trade it. Now, some of you guys mentioned already that potential Gartley pattern here as well. Yep. So if you're in advanced patterns, and advanced patterns have been kicking tail lately, my gosh. Every time you want to, do we? I think we do. Let me just check these lows here because our C leg cannot go beyond our A leg. Low is 171.73. Low is 171.78. Perfect. So we do remain above that leg. Yeah. So we could have a potential bearish Gartley forming as well. And this is one of our ratio patterns, as we call them advanced patterns here. It's going to look something like this. This first move down is our X to A, our starting point. We call this an impulse leg. We then have our first retracement. We want to measure where that retracement comes to. This one comes beyond the 618 Fibonacci retracement, which means we're on Gartley pattern alert. We then get a retracement right here. It's important that this C leg does not go beyond the A leg. If it does, it invalidates the pattern. And then specifically for the Gartley pattern, we'd be looking for a move back up to our 127 Fibonacci extension taken from the X to the A leg, or excuse me, the A to the B leg. And then our zone for our Gartley completion would go from the high of our X to this 127 Fibonacci extension, where we would be looking for potential short opportunity. So that is an opportunity that's on the radar here with the pound Aussie. At the same time, right, we know that our B leg is right here. What can be an available trade if that B leg is violated, just based off predictions that we would make? What would you guys say? Euro dollar. We got a bat pattern on euro dollar. Bear bat. Looked at euro dollar yesterday. Yep. So if we violate this level, we can expect a move up to, we can project a move up to the D completion. And again, lower time frame, this presents all type of opportunities as well, because this is a range from what? Basically 79 evens to 81. So almost a 200 pip range on a lower time frame, right? So that could be another thing that can be on your radar. Now we do have this has been disgusting for the last seems like the whole month of May. We do have this disgusting level of consolidation, which has been forming here on the pound Aussie. This is going to break at one point. Which way is it going to break? I don't know. No idea, but we'll wait and see. A break to the upside wouldn't be that significant until we clear the B leg. A break to the downside would be a little bit more significant because there's not really, we would expect a move to maybe not the lows, but the inside consolidation right here around 70. Was it 74.10, 74 even, something like that. So that could be an opportunity as well, but we can worry about that later. So double bottom, yes, depending on your rules. Is it a double bottom that should be traded? Well, definitely not right now because we've already moved off of it. At the time, you certainly could. So now the question that we need to ask is, what's next? What are the important points? And this is how I start my analysis every day. I draw out important points, right? And for me, important points are key levels of structure. I draw important points and everything works within that framework of important points, where it could be, hey, I don't care about this thing at all until we break these important points, or it's, hey, we have an opportunity and I want to trade it up to this important point. But it all is surrounded by Akil's important points. Awesome. Good stuff. Good stuff. Let me know if you guys have any questions on that, on pound Aussie. Specifically speaking to anyone, but specifically speaking to YouTube and TradingView, because we're about to get you guys out of here quickly. Live rumors, we've got plenty of time so we can discuss as much as you want. Is the Gartley D point usually at the 786 of X to A? No, it's at the 127 extension. Now, going back on the conversation with rules, depends on how you trade it. You can trade it we trade at the 127 extension. Right? You can trade it at the 786 of X to A. You can also trade it at the AB equals CD completion. Right? There are a wide range of rules for how to trade those depending on who you learn from. So we've adopted it to trade it at the 127 extension. I used to trade it at the perfect Gartley is where everything lines up. And I don't want to say it's the old way. It's not the old way. It's just a different way. Everyone trades it a little bit differently. So that's why we call them advanced pattern formations, because we trade them a very specific way. And it may not be the way that was originally in the book, right? The original Gartley, you guys ever heard of the 222 Gartley? I haven't brought that up in a while. The 222 Gartley is the quote unquote perfect Gartley. Yeah. So it's called a 222 Gartley because it was found on page, or talked about on page 222 in the book, right? But in that Gartley formation, right, what you do is you get a perfect, basically not a perfect, but a near perfect B leg touch of the 618. And then your Gartley completion is going to be at the AB equals CD and the 786. So if I do something like this, if I just draw this on, we'll see how this is the magic of ratios. So again, you can trade it at the 786 if you would like. You can trade it at the AB equals CD pattern. I used to get in trouble with Gartleys because I would trade them everywhere, right? So I would have 3 different rules for trading them. And then obviously, so let me ask you guys this, right? So I'm going to draw out the perfect Gartley here. And this, if I remember correctly, this second retracement had to come right between a 618 and a 786, somewhere like that. And then you got your AB equals CD pattern, which should put us, oops, copied the wrong thing. Sorry about that. We got our AB equals CD. Come on, Akil. Click the line, Akil. There we go. We got our AB equals CD pattern, which should put us, there we go. I need a little deeper retracement to that 786. So you see that one-to-one measure move, the AB equals CD? It puts us right at the 786. 127 would be there too, right? So that's kind of your perfect Gartley, where you get your 786, your 127, and your AB equals CD all lining up. So what I used to do is, because that was the perfect Gartley, and that's how I initially learned, right? I didn't really have any rules for trading a Gartley. The completion point was at the AB equals CD, the 786 or the 127. So let me ask you guys this. how many times is this perfect Gartley going to, how many times do you think we're going to see this perfect Gartley in the market? Rarely, right? So you may have you may have a situation where maybe this is a little bit shallower, right? And then you have something like this. So the problem with my consistency for rules is now I have a dilemma, right? Because I had 3 ways to enter, thinking that they would always line up right away. But now I had a dilemma, right? Because I had my 127 was right here. My AB equals CD was right here. My 786 is right here. So let me ask you guys this. How do I know where to enter? Which one do I do? It was easy when they all lined up. But if your B leg's a little high, if your C leg's a little short, then you get some differences between the completion points. So how do I know which one to go with? What's my solution? Any answers there? Any ideas? Where's my water? Speaking of stuff, there's my water. While you guys are typing that in, take a swig of the agua. Well, the answer was recency bias. The answer was recency bias. So if the last Gartley reversed at the 786, guess where I was trading this time? The 786. If the last Gartley blew past the 786 and reversed at the 127, guess where I was trading at? The 127. If the last Gartley reversed right at the AB equals CD, you know where those entries are at. The AB equals CD. All my decisions will be based off recency bias. Because it happened the last time, it means it's going to happen this time. And I was a reckless gambler in the market because I had no consistency in what I was doing. Right? So after diving into the numbers, it wasn't a rule. It was just it was a rule, Orsi. It was a rule. Do whatever I thought would work this time. It was in the trading plan, so I was allowed to do it. But yeah, I was all over the place. And obviously, I dug into my stats, and I'm like, wait a minute, this is dumb. I'm entering different ways each time, and then every time I enter, the other way wins, and all this dumb stuff. So I had to decide on a single way to trade it. So the thing is this, and you'll get this with I don't know if the bat is this way. I think the bat is pretty straightforward. But you'll get this in the cipher. We created a cipher, so we know what the rule is. But the point is this. You're going to see different rules for different pattern formation, whether you're reading Harmonic Trading by Scott Carney, whether you're reading Trade What You See by Larry Pesavento, whether you're looking into any other YouTuber out there that trades patterns, you may see them doing it a different way. You may see the 786. You may see the AB equals CD. You may see the 127. You may see, so we have really strict rules about Fibonacci requirements, right? So the B leg of a Gartley must hit the 618 Fibonacci retracement of X to A. So if this B leg is 1, I'm grabbing all the wrong things today. If this B leg is 1 tick short of that 618, is it a Gartley? Yes or no? The answer is no. Yeah, but Akil, it's close enough. Well, we don't use a rule that says close enough. However, there are other traders that use close enough, where there are these zones, if it's around the 618 or near the 618, right? So you're going to see different rules out there. What's important is this. You decide, and I would suggest you research it, and not research. I don't mean like just watch what other people are doing, but dig into the charts and look at the different scenarios yourself and kind of figure out which one you want to trade, right? One of the reasons I went with let me ask you guys this. What do you think one of the reasons I went with the 127 over a 786 was? Pop quiz. It's something that's very important to me. Think about. Yep. Better risk reward. Basically, trading at the 786 is like trading a cipher. It's the lowest point, so you'll get in the most trades, but you're going to get in early. You're going to have the lowest risk reward. Same thing with the AB equals CD. AB equals CD was very inconsistent because depending on the depth of the B leg, the depth of the C leg, that AB equals CD could sometimes be super high near X. It could sometimes be super low. It could even be lower than the 786 and sometimes. There was a lot of inconsistencies there. I chose the 127 and it was taught to me. I didn't make it up. But I chose to go with that method because it was the most consistent. It was the most consistent. It was also based off of Fibonacci extension, which I valued anyway. But the point is experiment, do research, find out which one meets your philosophy on the market, meaning it's something that you value. It meets the other requirements, whether it's risk reward or this or that. And then just be consistent in doing it. And it doesn't matter which way you choose, as long as you're consistent in doing it. So if you're consistent in doing it, then you can be consistent in testing it. If you're consistent in testing it, you'll have numbers based off that. And if those numbers work, then you know you've got something that works. Inconsistency is what kills traders. And again, apologies for the mute. I'm still having a crazy allergy attack this entire week. It's been a high pollen week, so I am dying. I've switched out noses 3 times and it's not working. But just got to survive one more day. So Liam says, this is so subjective. No, quite the opposite. Quite the opposite. Oh, sorry, I missed the first question. This is the most overcomplicated rubbish, just trade supply and demand? No, not at all. It's subjective if you don't do it the right way. And look, my trading philosophy is around support and resistance, supply and demand. So I know exactly what you're talking about. But here's the thing, right? And trust me, because this is the question I get from traders all the time, right? We have a bunch of courses. The first things we teach before any type of strategy or anything is how to read a price chart, how to identify the ebbs and flows, how to identify areas of support, resistance, supply, demand. And guess what? That is also subjective. That is also subjective, right? If you're going to be a discretionary trader, unless you're going to base everything off of indicators, there's going to be subjectivity. The problem is this: people use the excuse or the word. I'm not saying you're doing this, Liam, but just in general, people look at subjectivity as being a negative, right? How many of you guys initially hear subjectivity and think it's a negative? First of all, this is not subjective, right? If you ask me how to trade this pattern, it's rules based. It's black or white. The only subjectivity is identifying the initial X to A leg. Because if you ask me what it takes for a B leg to be hit, 618. What has to happen for the C leg, 618. What has happened for the D leg, 127. If it's anything other than that, it's not a pattern. It's either yes or no. So very little subjectivity if you know how to do it. But a lot of people look at subjectivity and they think it's a negative. But it's a negative because they haven't worked on it, right? So you mentioned supply and demand, right? Support and resistance. Let's look at a chart right here. You throw 100 traders in a room. Do you think they're going to mark up this chart the same exact way? What do you guys think? If you throw 100 traders in a room, you give them this chart and you say, identify key levels of supply and demand, identify key levels of support and resistance. Do you think you're going to get 100 charts that look identical? Yes or no? Same thing with Elliott waves, right? No effing way, right? No effing way. There's no way you are. Because we're all going to see it. This is the art side of trading. We're all going to see it a little differently. Now, here's the question. Is that a negative thing? Is that bad? If you get 100 traders and 20 of the charts look different? No. You know what's important? I'm going to pick on you, Bobby, because you're typing in. I saw you last. What's important is that Bobby trains his eye. He works on his skill of reading a price chart. And when Bobby is given this chart, if I give Bobby this chart 100 times and tell him to mark it up, let's say 97 of those charts are going to look the same. There's going to be human error, right? Bobby may have a tired day. He may miss something. There's going to be human error. But the key is that Bobby trains himself to be consistent in identifying whatever he wants to identify. And that's eliminating the subjectivity. It may be subjective in comparison to what someone else sees, but guess what? Do we care what other people see? If I'm marking up a chart, and again, I'm assuming I'm not like a new trader and I'm blatantly wrong. If I'm a skilled trader and I'm marking up a chart and someone else responds and says, oh, no, that's not a level of support. Do I care what that trader says? No. So I think it's interesting because, again, we talk about mechanical trading versus discretionary trading. And we always talk about the pros and cons of both. And you could be successful, wildly successful doing both. You can do wildly successful doing a blend between them all. But a lot of people look at subjectivity, and a lot of newer traders do it because they're not skilled enough they're not skilled enough at the time because they don't have the experience to be confident in their decision making, which makes perfect sense, right? When you don't have experience, you don't have confidence, it's going to be a little bit hard. But a lot of people look at subjectivity, oh, it's so subjective as a negative, where once you get experience in the market, you look at it, and not necessarily subjectivity, but discretion, you look at it as a positive. It is freedom. It is freedom. It is freedom for you to make decisions based on what you interpret. Where if everything is indicator based, there's no freedom in that. I told you guys stories when I used to trade indicator based systems and I used to get signals that I knew were wrong, but I had to take them anyway. Horrible. Now, again, that's knowing your personality as well. But let's not confuse subjectivity as being a negative. And let's not confuse discretionary trading as being highly subjective, because it's not. It is rules-based trading. The thing is, most people don't look at it that way. Most people think discretionary trading, right? You just do whatever you want. Everything we do here is rules-based. If you don't believe that, look at how many trading opportunities I see that I can't take because they didn't meet the rules. But everything is rules-based. Everything. That's called treating your trading like a business. So I take offense to this is the most overcomplicated rubbish, right? Because one, I don't think a trader should ever talk down about another trader's style. Right? If we learned anything from the Market Wizards books, right, you can be a successful trader looking at the almanac and trading the stars and the moons. Would I ever do that? No, I think it's ridiculous. But look, if it works for that person, it works for that person. Just because you have a preferred way of trading doesn't mean it's the only way that works. I love advanced pattern formations. You know what I love more than advanced pattern formations? Price action trading. If you made me choose one, it would be support and resistance, supply demand. If we're going off of just personal enjoyment. But don't call it overcomplicated until you understand it. Because the interesting thing is this. We try to teach someone supply demand, and there's a reason I don't teach supply demand. I just teach structure. The reason I don't teach specifically supply demand is because people don't understand it. It confuses people more than it hurts than it helps them. Believe it or not. It confuses people more than it helps them. So maybe that's overcomplicated. My markup analysis are different than Akil's, but the entry is the same. So similar conclusion. A million ways to eat the same apple. Yep. And what matters as traders, we find a way that works for us and we get good at it. Way or ways that work for us and we get good at it. And then if we want to add more stuff, we can add more stuff. If we want to take stuff away, we can take stuff away. That's the beauty of trading. It is our business. We are entrepreneurs. We can build it how we want to build it. Or she says everything is complicated till you work on it. Yeah. Look, I used to hate patterns, man. I got to measure this, then measure that, then do that and do that. And I can't see them. I used to hate them. But yep, everything is complicated until you work on it. Then it becomes simple once you master it. And if it stays too complicated, then you just don't do it. So didn't mean to pick on you, Liam. Hope it didn't seem like that. I really wasn't. But the comment brought back memories of battles I used to have when I used to argue with people. Battles I used to have on the internet, and it was always specifically with pattern trading, because it's a unique niche that a lot of people don't like, because it's not classical charting. But I hope I didn't offend. Was I mean? I don't think I was mean. If I was, I apologize. I don't think I was harsh. But I do think it was a good subject that was worthy of discussing. And I like Orsi's point, because there's a lot of newer traders out there that we just, whether it's a pattern trade or something we did the other day, it's like, man, this is so complicated, I'll never get it. You will. You just got to work on it. You will. You just have to work on it. It's like any skill, right? Riding a bike with no training wheels is complicated. At one point in time, it was very complicated, was it not? How do I balance, and how do I pedal, and how do I steer, and how do I do all these things at once? But once you master it, you hop on and just do it. Now you can do tricks and stuff. You can do wheelies. You can ride with no hands. The complicated gets simpler when you work on it. All right. Perfect. Good question, or good comment. Anything else before we get you out of here, YouTubers and trading viewers? Good little rant. That was good. We got a slow day, so it's always good to get a little educational rant out the way. And again, if you're still in here, Liam, I'm not sure if you are. Hope it didn't seem like I was personally attacking you. I was not. You weren't mean in any way. All right. On your way out, guys, do me a favor, hit that like button. I'll see you this weekend for a Trading Edge video. And then we'll be back here next week, again, every Tuesday, Wednesday, Thursday.